Have you ever felt like you were missing out on a financial opportunity hiding in plain sight? The kind that Wall Street insiders whisper about, but rarely share with the public? I remember sitting across from Vincent Iverson, a former bond trader who had worked at one of the largest investment banks in the world. He leaned forward, lowered his voice, and said something that genuinely shocked me. Most Americans are leaving thousands of dollars on the table every year because they simply do not understand how Treasury bonds actually work. This was not some get-rich-quick scheme or cryptocurrency gamble. He was talking about United States Treasury bonds, arguably the safest investment vehicle in the world, backed by the full faith and credit of the U.S. government. The same boring, play-it-safe investment that your grandfather probably recommended. What Vincent shared next changed my entire perspective on fixed-income investing. Treasury bonds, those seemingly dull government IOUs, have hidden features that less than 8% of retail investors fully utilize. These features can dramatically enhance returns, provide tax advantages, and even create income streams that most financial advisors rarely discuss with their average clients. Today, I am going to reveal 5 Treasury bond secrets that could potentially transform your investment portfolio. And the most surprising part? These strategies have been available for decades, hiding in plain sight, just waiting for ordinary investors to discover them. Before we dive into these little-known strategies, let us establish some context about Treasury bonds and why they matter more than ever in today's economic landscape. Treasury bonds are debt securities issued by the United States government to fund federal operations and public debt. They come in various forms: Treasury bills, T-bills, with maturities under 1 year, Treasury notes with 2 to 10-year maturities, and Treasury bonds with 20 to 30-year terms. When you purchase a Treasury security, you are essentially lending money to the government, which promises to pay you interest and return your principal at maturity. For decades, Treasuries were considered the ultimate safe haven investment, the place investors fled during market turmoil. But their reputation suffered during the prolonged low-interest rate environment following the 2008 financial crisis. Many investors began viewing them as dead money, safe, but with returns so low they barely kept pace with inflation. Penelope Clark, a 58-year-old high school teacher from Minneapolis, shared her experience. "I inherited about $200,000 when my mother passed away in 2015. My financial advisor suggested putting some in Treasury bonds for safety, but warned the returns would be minimal. I followed his advice and put $50,000 into Treasuries, but honestly, I felt like I was just letting that money sit there, doing almost nothing." This sentiment is common. Surveys show that among retail investors, Treasuries are often viewed as the investment equivalent of storing cash under your mattress, safe but unproductive. This perception persisted until recently when interest rates began climbing from their historic lows. But here is where our story takes an unexpected turn. Throughout this entire period, a small group of savvy investors were using Treasury bonds in ways that generated surprisingly robust returns, even during the low interest rate years. They were employing strategies that extracted value from these securities in ways that went far beyond the simple buy and hold until maturity approach most investors follow. I first discovered this when analyzing the portfolio of a retired accountant who had consistently outperformed market averages with a portfolio heavily weighted toward government securities. His strategies seemed counterintuitive at first. He was actively trading what most consider to be the most passive investments available. When I asked him about his approach, he said something I will never forget. "Treasuries are like Swiss Army knives. Most people only use the main blade, never discovering the dozen other tools built right into the handle." This retired accountant, Vernon Irwin, had spent years perfecting strategies that most individual investors never consider. "The Treasury market is the largest, most liquid market in the world," Vernon explained. "Yet most people do not understand how to extract its full potential." Vernon's portfolio had generated an average annual return of 7.2% over the previous decade, a period when most Treasury-heavy portfolios were yielding less than 3%. The difference was not luck or timing, it was methodology. What Vernon and other sophisticated investors understand is that Treasury bonds offer far more than just the face value yield printed on the certificate. They provide unique advantages that, when properly leveraged, can substantially enhance overall portfolio performance. But before I reveal these strategies, I need to address a critical question. Why are these approaches not more widely known? If they are so effective, why isn't every financial advisor recommending them? The answer lies at the intersection of financial education, institutional incentives, and complexity. Most financial advisors earn higher commissions on products other than Treasury securities. Additionally, some of these strategies require more active management and understanding than the typical set it and forget it approach many advisors prefer for their clients. Now, let us explore the first of these little-known Treasury bond secrets, and I promise this one alone could change how you view fixed income investing forever. The first secret lies not in any single Treasury bond, but in how you structure a series of them over time. Most investors who use Treasury bonds typically buy a single bond or a few bonds with similar maturity dates. But what if I told you that by strategically staggering your Treasury purchases, you could create a self-perpetuating income machine that significantly outperforms standard approaches? This strategy is called bond laddering, and while the concept itself is not secret, the specific application to Treasury bonds offers advantages that most investors completely miss. Let me explain how a basic Treasury bond ladder works. Instead of investing all your money in a single bond with one maturity date, you divide your investment across multiple bonds with staggered maturity dates. For example, with $100,000, you might invest $10,000 each in bonds maturing in 1, 2, 3, and so on up to 10 years. The conventional wisdom stops there, suggesting that as each bond matures, you simply reinvest in a new 10-year bond, maintaining the ladder. But here is where most people miss the arbitrage opportunity. Patricia Collins, a financial analyst who specializes in fixed income securities, discovered something fascinating when she analyzed historical yield curves, the relationship between bond maturities and their yields. There is a sweet spot in the Treasury yield curve that most individual investors completely miss, she explained. By concentrating your ladder in specific segments of the yield curve, you can enhance returns by 0.5% to 1.2% annually without taking on additional risk. This phenomenon occurs because of inefficiencies in how the Treasury bond market prices securities across different maturities. These inefficiencies create opportunities for strategic investors to capture excess returns through what bond professionals call riding the yield curve. Here is how it works. Treasury bonds with longer maturities typically offer higher yields than shorter-term bonds. As bonds move closer to maturity, they naturally migrate down the yield curve. A 5-year Treasury note becomes a 4-year note after 1 year, then a 3-year note, and so on. As this happens, its yield tends to decrease, which increases its price, creating potential capital gains in addition to the interest payments. Let me illustrate this with real numbers. Using data from the past decade, a traditional Treasury ladder across 1 to 10 years would have yielded an average return of approximately 2.4% annually during the low interest rate environment. However, a strategically constructed ladder focusing on the 2 to 7-year segment of the curve would have returned approximately 3.5% during the same period, nearly 50% more yield without assuming additional default risk. Vincent, our former bond trader, explained it this way: most individual investors think only about the coupon rate, the stated interest payment. But professional bond traders understand that total return comes from 3 components: coupon payments, reinvestment of those payments, and price appreciation from riding the yield curve. The last component is what retail investors almost always miss. This strategy becomes even more powerful during periods of yield curve steepening, when the gap between short-term and long-term rates widens. During such periods, the potential additional return can exceed 1.5% annually. But there is more to this story. The Treasury ladder strategy becomes exponentially more effective when combined with another little-known technique: strategic reinvestment timing. Most investors automatically reinvest funds from maturing bonds immediately. But historical data shows that Treasury yields follow seasonal patterns that savvy investors can exploit. Analysis of 30 years of Treasury market data reveals that yields tend to peak in certain months, often October and November, and reach their lowest points in January and August. By slightly adjusting your reinvestment timing to align with these seasonal patterns, you can potentially add another 0.3% to 0.5% to your annual returns. On a $500,000 bond portfolio, that additional 0.5% represents $2,500 per year in extra income, money that would otherwise be left on the table. This leads us to an important question. If these strategies are so effective, why does not everyone use them? The answer lies partly in complexity and partly in institutional barriers. Most financial advisors are trained to recommend products, not strategies. Building and managing an optimized treasury ladder requires ongoing attention and adjustment, something that does not fit neatly into the product recommendation model that dominates financial advising. Additionally, many brokerages make significantly lower commissions on treasury transactions compared to corporate bonds or bond funds. This creates a subtle disincentive to educate clients about advanced treasury strategies. But there is another, more surprising reason these strategies remain underutilized. The financial education industry has largely failed to bridge the gap between institutional knowledge and retail investor practices. The techniques I am describing are standard practice among institutional fixed-income managers but rarely make their way into personal finance books or financial literacy courses. This knowledge gap creates a market inefficiency that informed individual investors can exploit. By understanding and implementing strategies that institutions use but most individuals do not, you gain a significant edge in generating risk-adjusted returns. Now, let us move to our second Treasury bond secret, one that relates directly to taxes and can potentially keep thousands more dollars in your pocket each year. When most people think about Treasury bonds, they focus on the yield, the interest payment relative to the bond's price. But sophisticated investors understand that the true return on any investment is what remains after taxes. This is where treasuries offer a distinct and often overlooked advantage. Here is the secret that less than 10% of retail investors fully leverage. While interest from treasury bonds is fully taxable at the federal level, it is completely exempt from state and local income taxes. In high-tax states like California, New York, or New Jersey, this exemption can significantly enhance your after-tax returns compared to seemingly higher-yielding alternatives. Let me illustrate with a concrete example. Imagine you are considering two fixed-income investments. Option A, a corporate bond yielding 4.5%. Option B, a treasury bond yielding 4% at first glance. The corporate bond appears to offer a better return, a full 0.5% higher yield. But this surface-level analysis misses the crucial tax implications. If you live in California with a marginal state income tax rate of 9.3%, and you are in the 35% federal tax bracket, your after-tax yield would be corporate bond 4.5% times 1 to 0.35, 0.093 equals 2.51% after-tax yield. Treasury bond 4% times 1 to 0.35 equals 2.6% after-tax yield. Despite having a lower stated yield, the treasury bond actually provides a higher after-tax return. This tax arbitrage becomes even more pronounced in cities with local income taxes, such as New York City, where combined state and local rates can exceed 12%. Patrick Chun, a tax attorney specializing in investment taxation, explains, "I have clients who switch from corporate bonds to treasuries with lower nominal yields and end up with more spendable income. The tax advantage is real, but most investors, and even many advisors, fail to do the math. This tax advantage becomes especially powerful when combined with strategic allocation across different account types. By placing treasury bonds in taxable accounts and higher-yielding corporate bonds in tax-advantaged accounts like IRAs or 401(k)s, investors can optimize their overall after-tax returns. But there is an even more sophisticated application of this tax advantage, one that involves municipal bonds and what bond professionals call tax-equivalent yield calculations. Municipal bonds, or munis, are issued by state and local governments and are typically exempt from federal taxes and, in some cases, state and local taxes as well. The conventional wisdom suggests that high-income investors should prefer munis over treasuries due to their tax advantages. However, this conventional wisdom fails to account for risk-adjusted returns. Municipal bonds carry default risk, albeit usually small, while treasuries are backed by the full faith and credit of the U.S. government. When you adjust for this risk difference, treasuries often offer superior value, especially during periods of economic uncertainty. Vincent shared an insight from his trading desk days. During the 2008 financial crisis and again in March 2020, we saw huge value discrepancies between treasuries and munis. Investors who understood the relative value framework were able to capture significant excess returns by shifting between these asset classes at the right times. This brings us to a strategy that combines the tax advantages of both treasuries and municipal bonds through what bond professionals call tax arbitrage swapping. This involves strategically moving between treasuries and municipal bonds based on their relative after-tax, risk-adjusted yields. Here is how it works. Throughout the economic cycle, the relationship between treasury yields and municipal bond yields fluctuates. Historically, the ratio of AAA municipal yields to treasury yields ranges from about 65% to 110%. When this ratio rises above its historical average, municipal bonds offer better relative value. When it falls below the average, treasuries become more attractive on a risk-adjusted basis. By monitoring this ratio and adjusting your fixed income allocation accordingly, you can potentially add 0.75% to 1.2% to your annual after-tax returns without assuming additional risk, a significant enhancement to what most consider to be the lowest risk segment of their portfolio. Veronica Ingram, a portfolio manager who specializes in fixed income strategies for high-net-worth clients, puts it this way: most investors think bond allocation is a set-it-and-forget-it decision, but the relative value between treasuries and munis fluctuates constantly. By making tactical adjustments based on these fluctuations, we have consistently generated 1% to 1.5% of additional annual return for our clients. Now, I know what you might be thinking. This sounds complex and time-consuming. And you are right, it does require more attention than simply buying a bond fund and holding it indefinitely. But the financial rewards can be substantial. On a $1 million fixed income portfolio, an additional 1% return represents $10,000 per year in extra income. For those unwilling or unable to actively manage such a strategy, there are specialized fixed income funds that employ these tax arbitrage approaches. While they typically charge higher expense ratios than passive bond funds, their after-tax returns often more than justify the additional cost. This leads us to our third Treasury bond secret, one that relates to inflation protection and represents perhaps the most misunderstood segment of the Treasury market. When most investors think about inflation protection within the Treasury market, they immediately consider Treasury inflation-protected securities, TIPS. These bonds are designed to protect investors from inflation by adjusting their principal value based on changes in the Consumer Price Index, CPI. At first glance, TIPS seem like the perfect inflation hedge. But here is what most investors do not realize. TIPS often underperform conventional treasuries during inflationary periods due to how they are structured and priced in the market. Patricia, our fixed income analyst, explains, the problem with TIPS is that the market builds inflation expectations into their prices. If actual inflation matches those expectations, TIPS provide no advantage over conventional treasuries. They only outperform when inflation exceeds market expectations. Historical data supports this counterintuitive reality. During several inflationary periods over the past 2 decades, conventional treasuries actually provided better total returns than TIPS. This occurs because when inflation rises, central banks typically respond by raising interest rates, which affects bond prices. But there is an alternative inflation protection strategy using treasuries that few retail investors employ, combining conventional treasuries with Treasury floating rate notes, FRNs, in a specific ratio. Treasury FRNs were first issued in 2014 and have interest payments that adjust based on changes in the 13-week Treasury bill rate. This means that as interest rates rise in response to inflation, the yield on FRNs increases accordingly, providing indirect inflation protection. By combining conventional treasuries with FRNs in a carefully calibrated ratio, investors can create a synthetic inflation hedge that has historically outperformed TIPS during periods of rising inflation and rising interest rates. The optimal ratio depends on several factors, including the current yield curve shape and inflation expectations. Generally, a portfolio of 70% conventional treasuries and 30% FRNs has provided superior inflation-adjusted returns compared to a TIPS-only approach over the past decade. Vernon, our retired accountant, shared his experience. I switched from TIPS to a Treasury/FRN combination strategy in 2018. When inflation spiked in 2021 to 2022, My portfolio significantly outperformed what it would have done had I stuck with tips alone. The difference was nearly 3% in total return. But the real magic happens when you combine this inflation protection strategy with active duration management, a technique that even sophisticated individual investors rarely employ with their treasury holdings. Duration measures a bond's sensitivity to interest rate changes. Bonds with longer durations experience greater price volatility when interest rates change. Most bond funds maintain relatively stable duration profiles, which exposes investors to potential losses during rising rate environments. By strategically adjusting the duration of your treasury portfolio based on inflation trends and central bank policies, you can potentially enhance returns while reducing volatility. Specifically, shortening duration when inflation is accelerating and lengthening it when inflation is decelerating has historically added 1% to 2% in annualized returns compared to static duration strategies. This approach requires monitoring economic indicators and Federal Reserve communications, something that demands more attention than passive investing. However, the potential return enhancement justifies the additional effort for many investors. Vincent offers this perspective from his trading experience. The biggest mistakes I see retail investors make with treasuries is treating them as static, buy-and-hold investments. The institutional investors I worked with were constantly adjusting duration based on macroeconomic trends. That active management was often the difference between mediocre and exceptional returns. But what about investors who lack the time or expertise to actively manage duration? This brings us to an often overlooked alternative: Treasury separate trading of registered interest and principal securities, or STRIPs. STRIPs are created when the interest and principal components of a Treasury security are separated and sold individually. This creates zero-coupon securities that trade at deep discounts to their face value and have precisely defined durations. By purchasing specific Treasury strips, investors can create a portfolio with exact duration characteristics tailored to their inflation expectations, without the need for ongoing management. This set-it-and-forget-it approach to duration targeting provides many of the benefits of active management without requiring constant attention. This strategy becomes particularly powerful when combined with the next Treasury secret, one that relates to liquidity management and income generation. Most investors view Treasury bills, T-bills, simply as cash equivalents, ultra-safe places to park money temporarily. But sophisticated investors understand that T-bills offer opportunities for income enhancement through strategic liquidity management. Here's the approach that institutional investors use but most individuals never discover. Instead of keeping cash reserves in bank accounts or money market funds, they implement a rolling T-bill ladder specifically designed to maximize yield while maintaining necessary liquidity. The concept is straightforward but powerful. Rather than holding your emergency fund or short-term cash reserves in a savings account yielding perhaps 0.5%, you create a ladder of T-bills with maturities ranging from 4 weeks to 52 weeks. This approach typically generates 1% to 2.5% higher annual yield compared to bank deposits, while maintaining government-backed safety. But the real secret is in how you structure this ladder. Most individual investors who use T-bills simply buy them and hold until maturity. However, by strategically timing your purchases and sales based on Treasury auction cycles, you can capture additional yield. Treasury bills are auctioned on a regular schedule: 4-week and 8-week bills every Monday, 13-week and 26-week bills every Tuesday, and 52-week bills once a month. The yields on these auctions fluctuate based on market demand, Federal Reserve policy expectations, and other factors. By analyzing historical auction patterns, you can identify optimal purchase times. For example, data from the past decade shows that 26-week T-bill auctions typically offer higher yields when they coincide with major corporate tax payment deadlines, when corporations temporarily reduce their demand for short-term treasuries as they raise cash for tax payments. Penelope, who eventually learned these strategies and revamped her treasury approach, shares her experience. I moved my $75,000 emergency fund from my bank savings account to a strategically structured T-bill ladder. The additional income was about $1,500 in the first year alone, and this was money that was just sitting in savings before. But there is an even more powerful application of the strategy, one that combines T-bills with the options market to generate enhanced income while maintaining principal protection. This approach, sometimes called the Treasury Bill Plus strategy, involves investing the majority of your funds in T-bills while using a small portion to purchase call options on equity indexes or specific stocks. The T-bills provide principal protection, ensuring that, at minimum, you recover your initial investment when the T-bills mature. The call options provide upside exposure to equity markets. For example, with $100,000, you might invest $98,000 in 6-month T-bills yielding 5%, which would grow to approximately $102,450 at maturity. The remaining $2,000 could purchase call options on the S&P 500 index. If the market rises significantly, these options could generate substantial returns. If the market declines, your worst-case scenario is still a positive return from the T-bills. Vincent explains the institutional perspective. This strategy was popular among bank treasury departments and corporate cash managers. They needed principal protection but also wanted to enhance returns. The T-bill plus strategy gave them the best of both worlds, safety with upside potential. While this strategy introduces some complexity, the risk-reward profile is compelling, particularly during periods of market uncertainty. It provides definite downside protection with conditional upside participation, a combination that pure equity or fixed-income investments cannot offer. For investors uncomfortable with options, a simplified version of the strategy involves combining T-bills with small allocations to higher risk, higher return assets like emerging market bonds or dividend-focused equity ETFs. The principle remains the same. The T-bills provide a safety net while the riskier assets offer return enhancement. This approach is particularly valuable during periods of market volatility or economic uncertainty. When recession fears loom, investors often flee to cash, but traditional cash alternatives like savings accounts typically offer negative real returns after accounting for inflation. The strategic T-bill ladder provides safety with significantly higher returns. Now, let us explore our fifth and final Treasury secret, one that relates to portfolio leverage and risk management. The final Treasury secret involves using Treasury securities as collateral for low-cost financing, a technique that institutional investors regularly employ, but that remains largely unknown to individual investors. Here is how it works. When you own Treasury securities, you can use them as collateral for loans at rates very close to the federal funds rate. These loans, typically arranged through what is called the repurchase or repo market, allow you to access cash without selling your Treasury holdings. Traditionally, this market was accessible only to institutional investors and high-net-worth individuals. But in recent years, several brokerages and fintech platforms have democratized access, making Treasury-secured financing available to a wider range of investors. Vernon explains why this matters. The beauty of Treasury-secured financing is that it lets you maintain your Treasury positions for tax purposes, duration management, or yield curve positioning, while still accessing liquidity when needed. The interest rate spread, the difference between what your Treasuries yield and what you pay for the loan, is often positive, creating what is essentially free leverage. This strategy becomes particularly powerful in several specific scenarios. First, during periods of yield curve inversion, when short-term rates are higher than long-term rates, you can potentially create positive carry by borrowing against long-term treasuries to purchase additional short-term treasuries. This arbitrage opportunity is regularly exploited by hedge funds and bank trading desks, but rarely by individual investors. Second, Treasury-secured financing can be used for tax management. If you have unrealized gains in your Treasury holdings but need liquidity, borrowing against those positions rather than selling them allows you to defer capital gains taxes. This tax deferral alone can enhance your after-tax returns by 0.5% to 1% annually, depending on your tax bracket. Third, this strategy can optimize your overall portfolio risk-return profile. By maintaining your Treasury allocation for stability, while using Treasury-secured financing to fund investments in higher-return assets, you can potentially enhance portfolio returns without proportionally increasing risk. Patricia offers this perspective. Many investors face a false choice between safety and return. They think they must sell safe assets to buy growth assets. Treasury-secured financing lets you maintain safety while still pursuing growth. It is the financial equivalent of having your cake and eating it too. Of course, this strategy involves leverage, which inherently increases risk if not managed properly. The key is maintaining appropriate collateralization ratios. typically keeping your borrowing at 80% or less of your Treasury collateral value. Vincent, drawing on his institutional experience, cautions, Treasury secured leverage is like any tool, powerful when used correctly, dangerous when misused. The investors who get into trouble are those who push leverage too far or who do not maintain adequate liquidity buffers. For those interested in implementing this strategy, several mainstream brokerages now offer Treasury-secured lines of credit at competitive rates. Some fintech platforms specialize in this area, providing even more favorable terms for Treasury-backed borrowing. This financing strategy becomes even more valuable when combined with the other Treasury secrets we have explored, particularly the tax arbitrage and duration management approaches. By integrating these strategies into a comprehensive Treasury management framework, investors can potentially transform their fixed income allocation from a purely defensive portfolio component to one that actively contributes to overall returns. Now that we have explored these 5 Treasury bond secrets, you might be wondering, how can I implement these strategies in my own portfolio? What practical steps should I take to capture these benefits? This is where theory meets practice, and where your financial future could change dramatically. Let me share the story of Russell Thompson, a 62-year-old engineer approaching retirement. Like many pre-retirees, Russell had gradually increased his allocation to fixed income investments, including treasuries, as he aged. By 2019, approximately 60% of his $1.2 million portfolio was in various fixed income securities, with about half of that in Treasury bonds and Treasury bond funds. I was doing what all the retirement books told me to do, Russell explained. Shift toward safety as you get older. But my Treasury investments were barely keeping pace with inflation. It felt like I was doing the responsible thing, but at a significant cost to my future lifestyle. In early 2020, Russell attended a workshop on advanced fixed income strategies where he learned about some of the approaches I have described. Initially skeptical, he decided to test these strategies with a portion of his portfolio. He began by restructuring his Treasury holdings from a simple bond fund to a strategically constructed ladder focusing on the 3 to 7 year segment of the yield curve. He moved his Treasury investments from his IRA to his taxable account to capture the state tax exemption benefit, and simultaneously shifted his corporate bonds into his IRA. As interest rates began rising in 2022, Russell implemented the duration management approach, shortening his Treasury exposure primarily through FRNs rather than TIPS. He also established a Treasury-secured line of credit, which he used selectively to fund new investments without liquidating existing positions during market volatility. The results were remarkable. From 2020 through 2023, the Treasury portion of Russell's portfolio generated a total return of 15.8%, compared to the 7.2% return of the Bloomberg U.S. Treasury Index during the same period. This outperformance, more than double the benchmark return, translated to approximately $51,000 in additional wealth. What surprised me most was that these were not high-risk strategies, Russell noted. I was still investing in the safest securities in the world. I was just using them more intelligently. Russell's experience illustrates an important point. These Treasury strategies do not require you to abandon prudent investing principles or assume excessive risk. They simply involve applying institutional-level knowledge to optimize what is already the safest portion of your portfolio. Now, let us examine how you might implement these strategies based on different investor profiles. For conservative investors primarily concerned with capital preservation, the Treasury ladder and tax arbitrage strategies offer the most immediate benefits with minimal complexity. By structuring a ladder concentrated in the most efficiently priced segments of the yield curve and positioning Treasury investments in taxable accounts, you can enhance yields without changing your risk profile. For moderate investors balancing growth and income needs, the inflation protection strategy combining conventional Treasuries with FRNs, along with the T-bill income maximization approach, can provide both protection and yield enhancement. These strategies require more active management but can significantly improve risk-adjusted returns. For growth-oriented investors with longer time horizons, the Treasury-secured financing strategy offers the most substantial return enhancement potential. By using Treasury holdings as collateral for strategic investments in higher-return assets, you can maintain a safety net while pursuing growth opportunities. Regardless of your investor profile, implementation follows a similar framework. First, audit your current Treasury holdings. Determine what you own, where it is held, taxable or tax-advantaged accounts, and the duration and yield characteristics of each position. Second, optimize the location of your Treasury investments for tax efficiency. Generally, this means holding Treasuries in taxable accounts while positioning corporate bonds and other fully taxable fixed-income investments in IRAs or other tax-advantaged vehicles. Third, structure your Treasury investments strategically rather than passively. Whether through a carefully constructed ladder, a combined Treasury/FRN portfolio, or a T-bill maximization strategy, move beyond simple buy-and-hold approaches. Fourth, explore Treasury-secured financing options through your brokerage or specialized platforms. Even if you do not immediately implement this strategy, establishing the capability provides valuable flexibility for future opportunities. Finally, commit to ongoing education about Treasury markets and strategies. The fixed-income landscape evolves constantly, and staying informed is essential for capturing these benefits over time. Vincent offers this perspective. What separates successful fixed-income investors from average ones is not access to exclusive investments or insider information. It is the commitment to applying proven strategies consistently and adapting them as market conditions change. This adaptive approach is critical. While the strategies I have outlined have proven effective across different market environments, their specific application should adjust based on prevailing conditions. For example, during periods of rising interest rates, emphasizing Treasury FRNs and shorter duration conventional Treasuries typically provides better results. When rates are falling, extending duration through longer-term Treasuries or strips can capture price appreciation in addition to yield. Similarly, the optimal structure for a Treasury ladder changes based on the shape of the yield curve. When the curve is steep, with significantly higher long-term rates than short-term rates, concentrating positions in the intermediate segment often provides the best risk-adjusted returns. When the curve is flat or inverted, shorter-term Treasuries usually offer superior value. The key is understanding that Treasuries are not passive, set-it-and-forget-it investments. They are dynamic instruments that respond to economic conditions, Federal Reserve policy, inflation expectations, and market sentiment. By actively managing your Treasury allocation in response to these factors, you can potentially transform this traditionally defensive portion of your portfolio into a significant contributor to overall returns. Penelope, who restructured her inherited Treasury investments based on these principles, puts it this way: I used to think of my Treasury investments as the boring, responsible part of my portfolio, like eating vegetables because they are good for me. Now I see them as sophisticated tools that can be wielded strategically. My Treasuries are still the safest part of my portfolio, but they are no longer the least productive. The strategies we have explored fundamentally change how we should think about Treasury bonds within an investment portfolio. Rather than viewing them simply as safe but low-return investments, we can now see them as versatile financial tools offering unique advantages when deployed strategically. This shift in perspective has profound implications for investors across different life stages and financial situations. For younger investors building wealth, these Treasury strategies provide methods to enhance returns while maintaining safety nets. By implementing the Treasury-secured financing strategy, for example, a younger investor could maintain an appropriate fixed-income allocation for stability while using that allocation to support strategic growth investments. For mid-career professionals balancing growth with increasing capital preservation needs, the tax arbitrage and yield curve strategies offer ways to optimize their expanding fixed-income allocations. As these investors gradually increase their Treasury exposure, applying these strategies can significantly enhance their risk-adjusted returns during crucial wealth accumulation years. For near-retirees and retirees, these approaches address one of their most pressing challenges: generating sufficient income in a low-yield environment while protecting against both inflation and market volatility. The combined application of Treasury ladders, tax optimization, and strategic inflation hedging can potentially increase income by 1.5% to 2.5% annually, a meaningful difference for those living on portfolio distributions. Beyond these age-based implications, strategic Treasury management offers particular value during periods of economic uncertainty. When recession fears loom and market volatility increases, investors naturally seek safety. But traditional flight to safety, often means accepting minimal or negative real returns. The strategies we have discussed allow for maintaining safety without sacrificing return potential. Patricia explains, during economic uncertainties, there is typically a massive flow of capital into treasuries, driving down yields as prices rise. Investors who already understand how to extract maximum value from treasuries can benefit substantially during these periods, while others simply accept whatever yield the market offers. This brings us to perhaps the most significant implication: the democratization of institutional-level treasury strategies. Historically, the approaches we have discussed were primarily accessible to institutional investors with specialized knowledge and access to certain markets. Today, through online brokerages, fintech platforms, and improved financial education, these strategies are increasingly available to individual investors. Vincent notes, what is happening with treasury investing mirrors what happened with equity investing 2 decades ago. Just as discount brokerages and index funds democratize stock investing, new platforms and education are democratizing sophisticated fixed-income strategies. This democratization creates both opportunities and responsibilities. The opportunity is clear. Individual investors can now implement strategies once reserved for institutions, potentially enhancing returns on the safest portion of their portfolios. The responsibility is equally clear. These strategies require greater understanding and engagement than simply buying bond funds or individual treasury securities and holding them to maturity. For those willing to invest the time in understanding and implementing these approaches, the financial rewards can be substantial. On a $500,000 treasury allocation, the combined effect of these strategies could potentially generate $10,000 to $15,000 in additional annual returns compared to passive approaches, without assuming greater default risk. Even implementing just 1 or 2 of these strategies can make a meaningful difference. For example, simply optimizing the tax location of your treasury investments and implementing a basic laddering strategy could enhance after-tax returns by 0.75% to 1.25% annually, turning a $500,000 treasury allocation from a $17,500 annual income generator at 3.5% to a $21,250 generator at 4.25%. Vernon summarizes it well. Small percentage improvements in treasury returns might not sound exciting, but they compound dramatically over time. A 1% enhancement on your fixed income allocation, maintained over 20 years, can mean the difference between running out of money in retirement and leaving a legacy for your children. Beyond the direct financial benefits, strategic treasury management offers another advantage: reduced dependence on riskier assets to meet return objectives. Many investors feel compelled to overweight equities or alternative investments because they believe fixed income cannot generate sufficient returns. By enhancing treasury returns through these strategies, investors can potentially achieve their overall portfolio return targets with more balanced, less volatile allocations. This reduced volatility provides both financial and psychological benefits. Financially, lower portfolio volatility can improve compound returns over time by minimizing the negative impact of significant drawdowns. Psychologically, it can help investors maintain their strategies during market turbulence, avoiding the costly behavioral mistakes that often result from excessive portfolio volatility. As we look to the future, the strategic management of treasury investments will likely become even more important. With government debt continuing to grow globally, treasury markets will remain the world's largest and most liquid financial markets. Understanding how to optimize treasury allocations will be a crucial skill for investors seeking to balance safety and return in an increasingly complex financial landscape. Vincent offers this forward-looking perspective. The treasury market is evolving constantly, creating new opportunities for those who understand it deeply. The strategies that work today will need refinement tomorrow, but the fundamental principles, tax efficiency, yield curve positioning, duration management, and collateralized financing, will remain relevant regardless of where interest rates or inflation move next. Throughout this exploration of treasury bond strategies, we have uncovered approaches that can potentially transform the safest portion of your investment portfolio from a purely defensive holding to a significant contributor to overall returns. These strategies do not require sacrificing the principal protection that makes treasury securities so valuable. They simply extract more value from assets you may already own. As we conclude, I want to leave you with one actionable insight that you can implement immediately. Audit your existing Treasury holdings with fresh eyes. Look beyond the stated yield to examine how these holdings are positioned within your accounts, how their maturities are structured, and how they might serve as collateral for other financial objectives. Even if you implement no other strategy we have discussed, this audit alone will likely reveal opportunities for enhancement. The financial markets constantly evolve, offering new challenges and opportunities. But certain principles remain timeless. Safety matters, taxes impact real returns, structural inefficiencies create opportunities, and knowledge provides an edge. The Treasury strategies we have explored embody these principles, offering a path to potentially enhanced returns without sacrificing the security that makes Treasury bonds the foundation of many successful portfolios. In a financial world often characterized by extremes, excessive risk-taking during bull markets and excessive fear during downturns, the sophisticated use of Treasury securities offers a middle path, prudent investing with enhanced returns. By mastering these strategies, you take a significant step toward financial independence, transforming government debt from a passive holding to an active tool for building and preserving wealth. The true secret of Treasury bonds is not any single strategy or technique, but rather the perspective shift they represent, from viewing fixed income as a necessary portfolio component that constrains returns to seeing it as a sophisticated tool that can actively contribute to financial success. Strategic Treasury management proves that safety and return need not be mutually exclusive. With the right approaches, you can enhance both simultaneously, bringing you closer to financial independence with every carefully structured investment.